Now speaking, Weston Tucker, Head of Shareholder Relations. Thank you for the opportunity to present Blackstone's second quarter earnings. We reported GAAP net income of $1.2 billion and distributable earnings of $1.2 billion or 93 cents per common share. We declared a dividend of 79 cents per share, which will be paid to holders of record as of July 31st. Our results reflect strong performance across our business segments, with total assets under management increasing to $571 billion. We also saw strong growth in our private equity and real estate businesses, with total AUM increasing by $20 billion and $7 billion, respectively. We are pleased with our performance and remain confident in our ability to continue to deliver strong returns for our shareholders. Now speaking, Steve Schwartzman, Chairman and Chief Executive Officer. Good morning and thank you for joining the call. Blackstone has achieved a remarkable milestone, surpassing $1 trillion of assets under management, 3 years ahead of the aspirational roadmap presented at our Investor Day in 2018. This is a significant achievement for the firm, which was founded in 1985 with just $400,000 of startup capital. We have established an unparalleled global platform of leading business lines, offering over 70 distinct investment strategies. Our performance has helped secure retirees' pensions, fund students' educations, pay healthcare benefits, and protect and grow the savings of individual investors. We are also the leading innovator in our industry, having entered new areas such as hedge funds of funds, real estate, credit, private wealth, tactical opportunities, secondaries, infrastructure, insurance solutions, life sciences, and growth equity. Our scale and focus on data aggregation and analysis has allowed us to maintain a hands-on management style and identify trends before others. We have also established our own data science group and are rapidly expanding our capabilities in artificial intelligence. Our commitment to meritocracy has enabled us to attract and retain great talent, with 62,000 unique applicants for 169 first-year analyst positions this year. We are also an A+ rated manager of third-party capital distributed across hundreds of segregated investment vehicles, with virtually no net leverage at the parent company and no insurance liabilities. Alternatives have grown to $12 trillion of assets, and we believe that Blackstone is best positioned to capture future opportunities for growth in the alternatives area, including private credit and insurance, infrastructure, energy transition, life sciences, the development of the alternatives business in Asia, and the private wealth channel. Now speaking, John Gray, President and Chief Operating Officer. Good morning, everyone. Blackstone has achieved a milestone of $1 trillion in assets under management and is early in its expansion into markets of enormous potential. The company has delivered strong investment performance over the past 30 years, with net returns of 15% in corporate private equity and opportunistic real estate, 15% in secondaries, 12% in tactical opportunities, 10% in credit, 14% in infrastructure, 12% for Bright's largest share class, and 9% for institutional core plus real estate funds. In addition, Blackstone has produced over 150 basis points of excess spread over the past 6 quarters compared to investment-grade credit with similar ratings. This outperformance is driven by the company's thematic emphasis on winning areas such as global logistics, digital infrastructure, and energy transition. In the second quarter, inflows reached $30 billion and total dry powder is nearly $200 billion. Private credit solutions are in high demand and corporate credit insurance and real estate debt businesses comprised over 50% of Q2 inflows. Blackstone also held an accelerated first close of $1.3 billion for its European real estate flagship and expects another close later this month. The company is on track to substantially achieve its $150 billion target by early 2024. Blackstone is seeing strong momentum in its credit business, including global direct lending, PGIRD, and a green energy credit vehicle. In infrastructure, the perpetual BIP strategy is up 25% year-over-year to $37 billion. In the $40 trillion insurance channel, inflows from this channel were over $7 billion in the second quarter with more than $4 billion from its largest 4 clients. The firm is also investing in digital infrastructure and energy transition, having privatized the QTS data center business in Bright, BIP, and BPP for $10 billion and assembling the world's largest private lab office platform in real estate. In life sciences, Blackstone has established an extensive life sciences ecosystem with substantial capabilities and portfolio holdings across the firm. Finally, Blackstone is targeting the $80 trillion private wealth market with low single-digit allocations to alternatives today. The firm is confident in the reacceleration of growth in this channel given its portfolio positioning and exceptional performance. Overall, Blackstone is highly energized about the firm's prospects and is focused on building simple, scalable, and repeatable businesses to tackle opportunities of tremendous size. Now speaking, Michael Chai, Chief Financial Officer. Good morning, everyone. In the second quarter, Blackstone delivered steady financial results and resilient fund performance. Total AUM increased 6% year-over-year to $1 trillion, with earning AUM rising 7% to $731 billion, driving management fees up 9% to a record $1.7 billion. Fee-related earnings increased 12% year-over-year to $1.1 billion or 94 cents per share. Distributable earnings were $1.2 billion in the second quarter or 93 cents per share. Realizations in the quarter included Bright's sale of a resort hotel for $800 million, reflecting a 22% premium to its December carrying value and a multiple of invested capital of 2.2 times. Performance revenue eligible AUM in the ground increased in the second quarter to a record $504 billion and has more than doubled in the past 3 years. Net accrued performance revenue on the balance sheet grew sequentially to $6.5 billion or $5.31 per share. Corporate private equity funds appreciated 3.5%, while core plus funds appreciated 1.7% in the quarter. Private and liquid credit strategies appreciated 3.3% and 2.8%, respectively. BOM's BPS gross composite return was 1.9% in Q2. We expect fee-related performance revenues to further accelerate in the second half of this year, concentrated in Q4 with a number of scheduled crystallization events in the BPP platform. We are well positioned for an acceleration of realizations over time. Blackstone continues on a path of an expanding asset base, reaching $1 trillion today and, we believe, ultimately well beyond. With that, we thank you for joining the call and would like to open it up now for questions. Bank of America Merrill Lynch analyst Craig Siegenthaler inquired, what updates can you provide us on the partnerships you have formed in the U.S. banking industry, specifically in terms of buying and originating assets, and supplying capital? John Gray replied, Craig, banks are recognizing the potential of a partnership between their origination capabilities and our long-term capital. We've already formed and closed several of these partnerships, and have a strong pipeline of potential deals. Banks want to maintain relationships with customers while shrinking their balance sheet, and we're helping them do that. We're also working with larger financial institutions to provide balance sheet relief. This is beneficial for the financial system, banks, and our customers, and we expect this trend to continue to grow. Steve Schwartzman replied, the regulatory pressure is being felt across the U.S. and Europe, making it difficult for companies to keep their customers and produce assets due to limited balance sheets. This is an interesting area for us. Morgan Stanley analyst Michael Cyprys inquired, what is your outlook on the credit cycle given the better-than-expected credit losses in C&I loans, credit, and private credit? How much of the rate risk is hedged and for how long in the private credit markets? John Gray replied, given the rapid rate hikes by the Fed, it's surprising that there hasn't been more distress in the market. Default rates in leveraged loans are currently at 2.7%, approaching the long-term average of 3%. In our own portfolio, defaults are still less than 1%. This is likely due to strong earnings growth across our borrowers, cost structure optimization, and hedges in place for longer-term protection. Additionally, our non-traded BDC has an average loan-to-value of 43%, which is much lower than the 70+% leverage level seen in 2006 to 2007. This provides a cushion against potential distress going forward, though we expect things to get tougher. Michael Chai replied, our outperformance versus the overall market with respect to default rates has been pronounced. We attribute this to our focus on the 3 S's, scale, sector selection, and seniority. We are a large player and focus on larger issuers, which have proven to be more resilient in a high-inflation world. Our portfolio is also focused away from cyclicals and consumer discretionary companies, which has paid off. Additionally, 98% of our direct lending portfolio is senior secured, which is at the top of the capital stack and is very protected. We expect default rates to rise for the market overall and for us, but our experience and outperformance on default rates has been both historical and current. Evercore IC analyst Glenn Shore inquired, what is the current state of real estate leverage and debt service coverage, and what is the sales pitch for real estate in the current environment? John Gray replied, I'd say there's a bifurcation in commercial real estate. Office space in the U.S. is facing headwinds, with foreclosures and markdowns. Logistics, student housing, data centers and other sectors are performing well, with double-digit rent growth. Rates have leveled off and new supply is down, creating opportunities for investors. Debt costs are higher, so there may be need for capital injections. Sector selection is key, and these tailwinds should be helpful to the asset class over time. Deutsche Bank analyst Brian Bettel inquired, can you provide an estimate of the size of your direct lending and energy transition platforms, and a projection of their growth over the next 3 years? John Gray replied, I'd say that energy transition is an area of significant growth for Blackstone. We've just finished raising a $7 billion energy transition credit fund, and our energy equity fund is expected to be around $4 billion. Energy transition is a meaningful part of our $37 billion infrastructure business, and it's one of the fastest growing areas. We also have investments in energy transition in our private equity business. In the quarter, we invested a couple of $2 billion in a northern Indiana utility business and $1 billion in Invenergy, a large-scale renewables developer. We expect to invest $100 billion over the decade, and investor demand for exposure to this is growing quickly. The passing of the IRA has resulted in $250 billion of large-scale renewable projects announced in the last year alone. We see this as a very large-scale opportunity with potential for significant returns and fees for investors. Michael Chai replied, Michael here. The fair market value of our energy transition portfolio is currently over $20 billion, with additional capital soon to be invested. We have funds ready to invest in this area in the near future, so that number will grow. Deutsche Bank analyst Brian Bettel inquired, what capacity constraints, if any, could limit the growth potential of the direct lending franchise? Goldman Sachs analyst Alex Blostein inquired, John, what are your thoughts on capital velocity and fundraising for Blackstone over the next 6 to 12 months? How will the resumption of flywheel activity affect demand for different strategies? John Gray replied, Alex, you're spot on. The performance of our clients' investments is closely linked to the market. Many of them are currently over their allocations. For example, if they have a 13% allocation to private equity and they're at 15% or 16%. As equity markets rise, this frees up capital for them to potentially invest in private equity again. At the same time, as equity markets rally, IPO and M&A activity increases. Private equity sponsors and real estate sponsors can then sell assets, reducing the exposure in the numerator. We've seen this cycle many times before. We expect to see a pickup in activity due to the reduced uncertainty around banking, inflation and the Fed. However, it's too early to say that the all-clear has been given. Nevertheless, we are beginning to see a rise in activity, and a sustained good period for markets will be beneficial for our ability to raise capital from institutional and individual investors. There is still a lag in terms of fundraising activity, but this should improve over time. UBS analyst Adam Beatty inquired, what are your thoughts on the retail wealth management channel and its outlook for the back half of the year? John Gray replied, you hit the nail on the head. CURD has seen strong flows due to its attractive risk/return and equity-like returns with debt-like risk, up 60% from Q1. Bright has seen more negative sentiment due to commercial real estate, but share redemptions are down 30% from the beginning of the year. Performance has been strong, delivering a 12% net return over 6.5 years, 3 times the public right market. We remain confident in Bright and believe that getting through the redemption backlog will be beneficial. Autonomous research analyst Patrick Davitt inquired, what impact could the FTC's new merger guidelines have on your investment process? How much of your historical deal volume has been a result of platform and roll-up strategies? John Gray replied, the FTC's more assertive approach to mergers has been in place for the past 3 years, and we have been operating in that environment. We haven't seen a large impact on our activities, as many of the things we do, such as secondaries, real estate, and private credit, are not related. However, when looking to exit some of our businesses and talking to strategics, there is now a consideration of the likelihood of something getting through. This has had an impact on our thinking when it comes to the relative attractiveness of non-strategic players versus strategic players. We have been navigating this reality for some time and feel confident we will continue to do so. Barclays analyst Ben Budish inquired, could you provide some insight into the magnitude of the acceleration in fee-related performance revenues that you are expecting in the back half of this year? Additionally, what should we expect from fee-related performance revenues in 23 to 24 based on what you are seeing now? Michael Chai replied, Ben, we've been saying since early in the year that BPP fee-related performance revenues would be 4 times higher this year than last. About 60% of the net accrued performance revenue balance for BPP is scheduled to crystallize in the second half of the year, with most of that in the fourth quarter. Next year, AUM scheduled to crystallize will be lower, but our infrastructure fund will see a significant crystallization event. GERD and BXSL, our 2 credit direct lending perpetual vehicles, are steadily expanding and comprise about half of our fee-related performance revenues, up 67% year over year. So, there are multiple products at work here that are in position to generate fee-related performance revenues over time. JMP Securities analyst Brian McKenna inquired, what is driving the strong performance of your BCP Asia funds? Are you looking to expand in the region through organic growth or strategic M&A? John Gray replied, the real story in Asia has been India, where our team has delivered some of our highest returns globally. We've been a control-oriented investor there, which we believe is the right strategy. We're also seeing good opportunities in Japan, with more corporates selling off non-strategic divisions. China is more challenging due to economic and geopolitical issues, but Asia still offers plenty of opportunity. We have 8+ offices across the region and are looking to scale up our strategies in private equity, real estate, core plus, and credit. India will remain a mainstay for us, given its strong tailwinds. Keefe, Brewett and Woods analyst Mike Brown inquired, what progress have you made towards your $150 billion drawdown fundraising target, and what funds will help you reach it by early 2024? What growth opportunities do you anticipate in the wealth channel, and are there plans to launch new products into that channel this year or next? Michael Chai replied, we are on track to substantially complete our $150 billion flagship fundraise by early next year. We have had a first close for BREP Europe and expect to continue, as well as completing BCP9 over the coming quarters. We will also be fundraising for our successor vehicles in Life Science and GP Stakes Fund. Less than half of the $150 billion is currently earning management fees, but this percentage will accelerate over the coming quarters into 2024. John Gray replied, we are seeing more opportunity for individual investors to access alternative investments. We have a strong private wealth organization, led by Joan Solotar, that has built relationships with financial advisors around the world. Our competitive advantage is that we started this process earlier than others. The power of the Blackstone brand also gives us an edge when launching new products. We must ensure that the structure and returns are sufficient for a long-term partnership with financial advisors and their clients. We are focused and deliberate in our approach to launching new products, and we anticipate more opportunities in the future. BMO Capital Markets analyst Rufus Hone inquired, what is your outlook for FRE margin and core expense growth through the rest of 2023? Michael Chai replied, thanks for the question, Rufus. We typically encourage investors to look at full-year periods rather than quarterly periods when considering margins. We remain committed to our prior comments about margin stability in 2023 compared to fiscal 22. We have a disciplined approach to managing costs, however, there are a few caveats to consider in the second half of the year. OPEX is seasonally higher in the second half, and the first half of this year benefited from the absence of COVID costs. Therefore, the second half OPEX growth rate won't have that benefit. We suggest investors look at the full-year period for overall margin and comp ratio. Exane BNP Paribas analyst Arnaud Giblat inquired, what is the outlook for private credit deployment going forward? John Gray replied, transaction volume is linked to origination activity, and we have seen an uptick in the latter. This should lead to increased deployment of credit. The leveraged loan market could benefit from this enthusiasm, but private credit has a structural advantage due to its ability to offer price certainty to borrowers. When spreads tighten, the leveraged loan market becomes more competitive for existing loans. However, direct lenders have a sustainable advantage in new origination business. Weston Tucker replied, thank you for joining us today. We look forward to providing further updates after the call.